Assalamu-aleykum. Hey everyone, it's Fahan, and you're listening to the Nisa Invest Tea Talk podcast. I hope everybody's feeling good, ready to start your Friday. Alhamdulillah, it's Jummah today. And we're here to recreate in podcast form what happened last year at my local mosque sister circle, where a few of us got together and I was able to run a session on all things halal personal finance. Whether it had to do with halal investing, budgeting, pensions, we covered all of it. And at the end of the session, I asked my sisters to leave me with what further questions they had so I could cover it with you in podcast form. So thanks so much for joining me, and let's get started. So the question this week asks, I'd like to know more about digital assets. Now, this means that this is going to be the episode where we talk about cryptocurrencies and NFTs. So these are two common examples of what are called digital assets. Now, it's important, especially if we take things step by step, is to first of all understand where is it that cryptocurrencies fit within the broader landscape of what's available to invest in. So cryptocurrencies and digital assets in general, they would fall under the bracket of an alternative investment. So what do we mean by that? An alternative investment is anything that would fall outside of a traditional asset class. And there are pretty much four main asset classes. There is cash, there is what we would call fixed income, so that includes bonds and Islamic bonds called sukuks. And then you have property, and then you've got stocks and shares. Now, in the past 15 years, what we've seen is the development of what we'd call the digital asset classes. So I thought that in this episode, we would probably focus on, I would say, three main things. First of all is to understand exactly how is it that cryptocurrencies work, how is it that they've come about. Second, because by definition these digital assets are very high risk and speculative in nature, and so the thing to really understand is exactly what are the risks that are involved, and how is it that we should think about them. Because I feel like once you do, like with anything, making an informed decision that is aligned with your risk tolerance and your goals is super important. What else did I want to cover? I also wanted to cover how regulated they are. So what is it that the regulation says about what we can or can't do with cryptocurrencies. Lastly, because the sister asks about digital assets more broadly, we'll talk about not only Bitcoin and cryptocurrencies, but also NFTs. So first of all, what are cryptocurrencies? How is it that they came about to begin with? Now, before the actual history, perhaps it's nice to just reflect on our own personal history. So maybe ask yourself, when was the first time that you ever came across the word cryptocurrencies or the word Bitcoin? For me, I think I may have heard it when I was at university, so at the beginning of the previous decade, not this one. But I do remember around 2016 and 2017, at the time I was working on a trading floor. So that was the first time I remember seeing the very big spike in Bitcoin. So some of my friends and colleagues were all talking about what we thought of Bitcoin and that kind of stuff. And at the same time, you may have friends or relatives at university, and I'd hear stories of people in lectures waiting for an ICO, which is an initial coin offering, which is like the opposite of what you would call an IPO, which is when a company first comes to market. I remember when I first heard that term, I thought, ooh, wow, I can't believe that also exists. In more recent times during COVID, there was huge spike in cryptocurrencies, and you really could, for a period, you really could not get away from hearing about it. It started in 2009 in the wake of the financial crisis, and it was a response to the mood at the time, which was for individuals to be able to have control of their money without the implicit reliance on banks, companies, and governments. Because we have to implicitly trust these institutions that didn't do any good, because look what happened with the financial crisis. So bearing that in mind, the idea of not having to rely on institutions to exchange value in the form of currency, it was seen as a revolution for the financial world, first of all. Second of all, it was meant to be a way for people to create a new digital form of value exchange. And the way it was going to do that, it was going to have to be built around the concept of decentralization. So if we bear in mind these three things, it was going to be revolutionary, it was going to be a new way for people to exchange value, and it was going to be built around decentralization. So if we think about the term cryptocurrency, it really is in the name. So if we break it down, it is a currency, meaning that it's a way for people to exchange value, and it uses encryption technology as a way to control the amount of currency that is issued, but also as a way to record ownership and payments. Like in the olden days, you'd have ledgers where the bank would literally write down when people would withdraw money, and they would just keep it in account as a ledger. Effectively, this ledger for cryptocurrencies is built on the blockchain. So when people say that cryptocurrency relies on the blockchain, it acts as this distributed and transparent digital ledger. And the whole principle of using the blockchain is because it allows to maintain the decentralized nature of cryptocurrency. The first coin that was created, the first currency, was Bitcoin. And it's still probably the one that most people are familiar with. Another one is Ethereum. But if you took a guess of how many cryptocurrencies is out there, and I checked in preparation for this episode, and now you've got 22,000 different currencies. And the value of those crypto assets altogether, they come up to 850 billion in market capitalization. So without risking to sound too simplistic, how is it that you actually get crypto? Firstly, you can buy it. So you buy it in exchange for another currency. You can also earn it. And this was like at the very beginning of cryptocurrency. It was very popular to hear people say that they were being paid in crypto. And this was meant to be like almost like not really like a joke, but people who believed in that technology, and maybe at the beginning it was really easy to come by in terms of actual coins. Now we would really only buy it in fractions, because one Bitcoin is worth upwards of £35,000. And then there is this thing that you also hear, which is you can mine cryptocurrencies. So that is when you use really extensive data and resources to solve these mathematical problems that allow you to generate what's called cryptographic keys. So effectively to issue new crypto. So bearing all of this in mind, you now hold crypto as an asset, and that asset, like with any other type of asset, has its own risk and return profile. And with cryptocurrency, the way you would describe that risk profile is one that is really speculative and really high risk. So the moment that someone exchanges their pounds to crypto, they have to be aware of what is it that they have that they're currently holding. And so for the second part of this podcast, we'll effectively just go through what are the factors to consider when holding crypto and what are the risks that are involved. With any investment, the first thing to think about is the rate of volatility. So with cryptocurrencies, they are known for their price fluctuations to be incredibly volatile. So it is not uncommon to see cryptocurrencies change by hundreds or even thousands of pounds in short periods. And the reason for this, firstly, people need to intrinsically believe in the value of crypto. So if for any reason people's opinions change about how cryptocurrencies work as a store of value, that will impact the price of it. Secondly, if generally there is something that changes about the market sentiment towards cryptocurrencies, maybe somebody says something, for instance, if Elon Musk tweets saying, now you can buy Teslas using crypto, that, of course, will have an impact on the market of cryptocurrencies. Or thirdly, because security is also a big factor here, so if suddenly people believe that their cryptocurrency is not secure, that will also impact the price of it. When you think about cryptocurrencies and how is it that they might differ from another currency, it is in the name and in the history of crypto the fact that it's decentralized by nature. That means that they don't have, if you compare it to another traditional currency, they're not reserve backed, meaning that they are not backed by a central bank or a government that will guarantee its value. And if we really think about it, that's part of the risk of cryptocurrencies and the reason they were created in the first place, because they wanted to be decentralized. They didn't want to have to face another counterparty, another bank, whilst dealing with each other in dealing with crypto. So when you buy and sell crypto, you do that in a decentralized way, meaning you don't have a counterparty in the middle. That removes what's called counterparty risk. And when people trade cryptocurrencies, they do so in a decentralized network. And what does that decentralized network create? It creates the fact that you no longer have someone in the middle acting like a counterparty to remove some of that risk for you, of you not being able to find a market for your cryptocurrency. And why does that present a risk? That market will suffer from low volumes and liquidity. And a lot of alternative investments, that is one of the intrinsic risks that they have that other traditional asset classes might not have. And so I feel like one topic that is really good to keep in mind is, of course, volatility. But another one that is equally important to bear in mind as an investor is the idea of liquidity. And if you have an asset that its market is very liquid, the risk that removes for you is it allows you to buy and sell it with ease, because you know that you will be able to find someone who will buy it at that price, and that there is going to be either a lot of volume or a lot of liquidity in that market. So yeah, it's almost appreciating the fact that, yes, maybe you're in a market that has really high price fluctuations, but if you cannot find someone who will buy it at that price, that is almost no good to you. But I feel that if we delve in a little bit deeper, there is a level of protection that you get from financial regulation. In the UK, it's called the FSCS, so that's the Financial Services Compensation Scheme, where if something happens to the bank for a certain amount of money that you have, I think it's actually set at a cap of 100,000 euros. So in the UK, it's like roughly £85,000. And so your current account is protected up to £85,000. So if you wanted to get rid of that operational risk, you just maybe open many different accounts to put up to £85,000 in, because any money that you have over that amount, if something were to happen operationally to the bank, you wouldn't have recourse to that money. And so how does that relate back to crypto? Cryptocurrencies in the UK are not covered by the FSCF. So if we talk about the three different risks, we said volatility is one, fair enough. Low liquidity and low market volumes because of the decentralized nature of crypto is another. Third, there is also regulatory risks that you have to bear in mind with crypto that other asset classes do have protection over. If you have seen banks go under, knowing that you are covered up to £85,000, that means something to you, and so you want to make sure that you're covered by that amount, but maybe that doesn't cross your mind if you haven't ever seen what's called a bank run, where the bank literally runs out of money. But that is what happened during the financial crisis. In the UK, an example of one was Northern Rock, where people were literally filing outside of the ATM machines to get their money out. Something similar also happened in Greece during their sovereign debt crisis, and a very famous basketball player in the US, he's Greek-Nigerian. He plays for the NBA. For Milwaukee. I have no idea. I'm gonna guess when he obviously got paid a lot of money when he joined the league, he didn't want to keep that whole cash into his account, and so he opened a bunch of current accounts, and what he was trying to do is effectively get rid of that counterparty risk or that operational risk presented by the fact that his money is with a third party. And so he wanted to be covered up into that amount. But of course, he's falling back to his memory. Maybe he was a child when, in 2012, his country went through that crisis. So yeah, that was a little bit of a detour, but effectively, I think it does sum up some of the risks involved with cryptocurrency. And it kind of leads into my topic about regulation, because in the UK, cryptocurrency it just keeps getting increasingly regulated, because what the Financial Conduct Authority is trying to do is protect retail customers in particular. So that's why I'm pretty sure it's illegal in this country for someone to directly sell cryptocurrency to retail customers. So somebody actually making an advert for cryptocurrency, that is not allowed. Even though, cryptocurrencies are meant to be decentralized in nature, you've got these actors that are effectively called people who provide crypto wallets. So a way for people to store their crypto and trade their cryptocurrency. And so you have to kind of be, in your mind, aware that you're adding a bit of counterparty risk. So it's not like it's pure crypto in its theoretical sense, but you're using a crypto wallet provider. Anyhow, those crypto wallet providers, which they see themselves as an entry point for the average person on the street to have access to cryptocurrency, they have to go through immense lengths to make their customers aware of the risks involved with dealing with cryptocurrency. And in fact, I got an email, which is so well timed to this episode, but I got an email telling me that for me to keep using their crypto wallet, I have to pass this exam, which is called an appropriateness test. So it's effectively testing my knowledge of the risks involved with cryptocurrency. And on the dashboard, you see at the very top saying cryptocurrencies are incredibly highly speculative. You need to be comfortable with losing everything that you've invested in cryptocurrency. And that's why even though, we talk about even when you invest in stocks and shares, you have to be mindful that the money that you've invested, you have to be comfortable and withstand the risk of it all going. For cryptocurrency, it's really like, yes, we mean that when we talk about equities, you should be able to see it go down to zero and not react for at least 5 years in order for it to compound and for you to get the commensurate return for the risk that you took. With cryptocurrency, the risk isn't just that it could go down to zero. Even if it goes to the sky, there's no guarantee that the crypto provider won't fail, that you'll find anybody that will buy it at that price. So if there is anything that you put into crypto, and we love a rule of thumb, there's a rule of thumb that, for really very small, like less than 10% of your investable assets, so it's not like all of your wealth, but the money that you have available to invest, that is the kind of amount, if you are going to consider putting into anything highly speculative or any kind of alternative investment, like for even if you were to buy rare pieces of art or that kind of stuff, you are going to want to do that with a very tiny amount of your portfolio. And quite literally, if that money disappeared, it wouldn't have an impact on you personally in terms of how is it that you're able to live your life. It isn't money that you had earmarked for something important. That is the kind of messaging that crypto wallet providers need to get out, and they have to be registered with the FCA. I feel like that's the direction that the regulation is going. It's because of the need to protect consumers for the risks that are involved with cryptocurrency. So very briefly, I touched on examples of alternative investments like art and that kind of stuff. Now, that is a nice segue into the last bit of things to talk about within digital assets, and that is the advent of non-fungible tokens, which are called NFTs. Now, NFTs are effectively a digital version of a collector's item. And so you may think of, if someone buys an alternative investment, they might end up with a painting, or they might end up with a collectible coin, or a piece of antique furniture. What NFTs are trying to create is effectively create digital versions of these. Firstly, I with NFTs, I feel like it's useful to think about the ways they're similar to cryptocurrencies. So firstly, NFTs also rely on blockchain technology. And the reason they do so is because they use it as a way to store ownership of that token. So if you've created a digital token that reflects ownership of a particular digital asset, it is then stored on the blockchain. If you need to give someone license to use that digital token, that is also recorded in the blockchain. So in the name non-fungible token, the idea of it being non-fungible effectively means it cannot be replicated. So it's a way of saying that it's unique. And that is another way that they're different to cryptocurrencies, because one Bitcoin is the same as another Bitcoin, but one NFT is not the same as another NFT. And as a result, there isn't a common value attached to an NFT. Instead, it literally works the same way as any collector's item would, in the sense that it's only as valuable as someone's willing to pay for it. So I feel like perhaps an example would be helpful. So I've got here an example of an NFT that was based off of a digital asset. So here is the Twitter CEO's first tweet. So someone might say, oh wow, if I own the very first tweet, that might be something of value. Let me create an NFT out of that. And it just said, just setting up my Twitter. Anyhow, at an auction, it sold for 2.9 million. And this was in 2021. And that unique piece of code is what the NFT is, was attached to the downloadable tweet and then stored on the blockchain as a way to represent ownership of that asset. So this would effectively be the comparison of what happens when you buy a house. You need like a piece of paper to show that you own the house, and that's called the deed. And so you can think of NFTs stored on the blockchain as effectively being the deed to someone's house. But instead, in this case, it represents not the ownership of a house or a piece of land, but rather the ownership of Jack Dorsey's first downloadable tweet. And by having an NFT saved onto the blockchain, that effectively acts as the deed that represents your ownership of the asset. Now, and then they get traded in digital markets. If we think about, again, our comparisons between NFTs and cryptocurrencies, it goes without saying, similar to cryptocurrencies, they're not regulated by the Financial Conduct Authority, in the sense that you cannot, if something were to happen, if you got scammed, there's no court of where you could go to argue your case as an investor if something went wrong. I feel the main big difference between cryptocurrencies and NFT, there is no value that can be agreed for a particular NFT, in the sense that it really is a matter of what someone is willing to buy it for. That very same tweet that I gave as an example, it was first sold at an auction for $2.9 million in 2021. So people at the time, that's what they thought that Jack Dorsey's tweet was worth. Now, the same NFT was then sold at another auction in April 2022, and then it just went for $280. That tells you everything about what can happen to the value of an NFT. And really, it's not a way to say something is good or something is bad. We're just saying that the return profile of an NFT and the risk profile of an NFT is such that it is different to the traditional asset classes, is more akin to things that are whose value is based off of the general public's willingness to attribute value to the creativity or the uniqueness of a particular asset. However, they're both under the bracket of digital assets because of the way in which they use the blockchain to create these markets and these assets. Because all of this technology, in its strictest sense, is incredibly new, it is very fascinating to see how the regulatory landscape is rushing to keep up. Whilst NFTs, perhaps you can agree with me, they've kind of gone away from the general population's discussion of them, cryptocurrencies are still very much in people's frame of reference. Now, you know that if you open an account with any type of crypto wallet, you can be expected to take a small test about the appropriateness of you as an investor into crypto, and that is intended to protect you as a consumer. You won't see anybody selling you crypto in the sense that someone making an advert for that. It's important to instead arm yourself with as much knowledge, and what I enjoy doing is kind of think about these asset classes on a spectrum and compare the pros and cons of all of them. How is it that they move? And if you, I feel, start to describe these markets in terms of, okay, what is my counterparty risk? What is the volatility involved? How liquid is this market? What is my risk profile? How much of my investable assets am I going to allocate to this particular asset class? That allows you to, first of all, not put your hard-earned money into unnecessary risk. You start to think of yourself as someone who's been empowered with knowledge and is able to make informed decisions in line with not only their goals but also their risk profile. So I hope that was a helpful discussion about all things digital assets. That was effectively the end of the things I wanted to discuss relating to cryptocurrencies and non-fungible tokens and the risks involved. Thanks so much for listening. This has been the Nisa Invest Tea Talk podcast. I will see you next Jummah. Assalamu-aleykum. Bye for now.